Hello and welcome back to another episode of SEB Finance, your go-to platform for everything personal finance and money management. In this episode, we will talk about the 4 types of investment accounts, but before we get started, ensure to like, share, and subscribe. Investing is a way to grow your wealth over time. It allows you to put your money to work for you so you can achieve your financial goals. There are several types of investments available, but 4 of the most popular options are bonds, stocks, mutual funds, and exchange-traded funds. In this episode, we will explain what each of these investment options is and how they work. Number 1, bonds. Bonds are debt securities that are issued by companies, municipalities, and governments to raise capital. When you purchase a bond, you are essentially loaning money to the issuer for a set period of time. In return, you receive regular interest payments, and at the end of the bond's term, you receive your principal investment back. This is because bonds are typically issued with a specific maturity date, ranging from a few months to several decades. The longer the term of the bond, the higher the interest rate is likely to be. This is because longer bonds carry more risk as economic conditions and interest rates may change over time. Bonds are considered relatively safe investments because they offer predictable rate of return and have lower volatility than stocks. They come with a fixed interest rate known as a coupon rate, which is paid out to the bondholder at regular intervals, typically semi-annually or annually. At the end of the bond's term, the issuer repays the principal investment to the bondholder. There are several types of bonds, including government bonds, municipal bonds, corporate bonds, and high-yield bonds. Government bonds are issued by the federal government and are considered to be the safest type of bond. Municipal bonds are issued by state and local governments to fund projects such as schools and roads. Corporate bonds are issued by companies to fund operations or expansion, and high-yield bonds are issued by companies with lower credit ratings and carry a higher risk of default. Bonds are considered a relatively safe investment because they offer a predictable rate of return and have lower volatility than stocks. Bonds can be a good investment option for those seeking a more conservative approach to investing or those looking to diversify their portfolio. It's important to consider factors such as credit quality, maturity date, and interest rate risks when selecting bonds to invest in. Number 2, stocks. Stocks, also known as equities, represent ownership in a company. They are considered a higher risk investment than bonds because their prices can be more volatile. However, over the long term, stocks have historically offered higher returns than bonds. When you buy a share of stock, you become a part owner of the company and you are entitled to a share of its profits, known as dividends. And you have a right to vote on certain matters, such as board elections and major company decisions. Stocks can be divided into 2 broad categories: common stocks and preferred stocks. Common stocks are the most common type of stock and represent ownership in a company, while preferred stocks, on the other hand, typically offer a fixed dividend and have less potential for capital appreciation. The price of a stock can fluctuate based on a variety of factors, including the company's financial performance, industry trends, and global economic conditions. Stocks can be purchased through a brokerage account, either online or through a traditional brokerage firm. It's important to research and evaluate individual companies before investing in their stock, and some of the key factors you might want to look at include the company's financial health, growth potential, competitive position, and valuation. Stocks can be a good investment option for those looking for long-term growth and are willing to accept higher levels of risk. However, it's important to diversify your portfolio and not rely too heavily on any single stock or sector. Number 3, mutual funds. A mutual fund is a type of investment vehicle that pools money from different investors to buy a portfolio of stocks, bonds, or other securities. Each mutual fund is managed by a professional fund manager who makes investment decisions on behalf of the investors. The goal of a mutual fund is to provide investors with a diversified portfolio of investments that are professionally managed. This helps reduce risk and increase potential returns. Similarly, mutual funds can be divided into several categories based on the investment objectives, such as growth, value, income, or a combination of these. They can also be categorized by asset class, such as stocks, bonds, or a mix of both. One advantage of investing in mutual funds is that it offers diversification, which means your money is spread across multiple investments. This helps reduce risk, as a decline in value of one investment may be offset by gains in another. Additionally, mutual funds offer professional management and research, which can be helpful for those who are new to investing or don't have the time or expertise to manage their own portfolio. Thing to note, mutual funds do come with fees, such as expense ratios and sales charges, which can eat into your returns. It's important to carefully evaluate these fees before investing in a mutual fund. Number 4, ETFs. An ETF is similar to a mutual fund in that it pulls money from different investors to buy a portfolio of stocks, bonds, or other securities. However, ETFs are traded on stock exchanges like individual stocks. Like mutual funds, ETFs pull money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. However, unlike mutual funds, ETFs are bought and sold throughout the day on an exchange, and their prices can fluctuate based on supply and demand. ETFs are also typically lower cost than mutual funds because they are passively managed. The one advantage of investing in an ETF is that it offers diversification, which means that your money is spread across multiple investments. Additionally, ETFs tend to have lower fees than mutual funds as they don't require the same level of active management. The one thing you need to note, however, is that ETFs come with risks, such as market volatility and liquidity risk. Additionally, some ETFs may be more complex than others, and it's important to carefully evaluate the underlying holdings and investment objectives before investing. They can be a good investment option for those looking for diversification, lower fees, and flexibility. However, it's important to carefully evaluate the risks and investment objectives of the ETF before investing. Please note, each of these 4 investment options has its own unique characteristics and risks. It's important to understand the difference between them, as well as your own investment goals and risk tolerance before choosing where to invest your money. Thank you for tuning into this episode. We hope that you did learn a thing or two, and we wish you the very best of luck as you get started with your investment journey. Before you leave, ensure to like, share, and subscribe. And if you have any topic that you'd like for us to research and give feedback on, please feel free to leave a comment, and we'll do our best to ensure that we create content around the topic.